Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHUI on Land Limited Annual Report. SHUI on Land Limited offers a diverse range of businesses and services on land. The company's primary focus is on property development, where it develops and sells residential and commercial properties to meet the growing demand for housing and office spaces in China. In addition to property development, SHUI on Land also engages in property investment, acquiring and managing a portfolio of properties to generate rental income. The company provides property management services to its clients, ensuring that their properties are well-maintained and efficiently managed. The company's construction segment offers a range of services, including construction, interior fitting-out, renovation, and maintenance for building premises. This allows SHUI on Land to provide turnkey solutions to its clients, from development to completion. Furthermore, the company provides debt financing and management services, offering financial support to its clients and managing their debt obligations. Overall, SHUI on Land Limited's comprehensive range of businesses and services enables it to offer a one-stop solution for all land-related needs in China. SHUI on Land Limited market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $17 billion. SHUI on Land Limited trades at a lower price-to-book ratio of 0.1 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 7.69%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, sustained rental growth, robust momentum in retail sales and shopper traffic, and expansion of asset-light projects have contributed significantly to revenue increase. Additionally, strong sales performance at specific developments such as Wuhan Xinqiandi and Shanghai Xinqiandi, along with the successful launch of Riverville, have also boosted revenue. Furthermore, the company's asset-light strategy, financial investors for mature commercial assets, new development projects through partnerships, management fee income from various sources, urban renewal product line expansion, increased construction income, and other revenue growth have all contributed to the overall revenue growth. On the decline side, a decrease in contracted property sales by 47%, decline in average selling price, ASP, for residential property sales, changes in project mix, losses from impairment provision for assets classified as held for sale, net loss from commercial properties, and prolonged property slump have led to revenue decline. The constrained financing conditions in the residential property sector have also had a negative impact on revenue. Overall, these factors highlight the complexities of revenue growth or decline and the need for companies to adapt to changing market conditions. The net income of the company underwent a significant transformation between 2024 and 2025. Initially, it decreased by 60%, plummeting from RMB 5,228 million to RMB 12,115 million. However, this trend was reversed in 2025 when the company turned its losses into profits, with a notable improvement from a loss of 1,733 to a profit of 810. The change in net income can be attributed to various factors, but one key aspect is the improvement in net profit margins. In 2024, the net profit margin was a staggering negative 42%, indicating severe financial struggles. However, by 2025, this figure had improved dramatically to 10%. This significant increase in net profit margins suggests that the company's management made substantial efforts to optimize its operations and reduce costs. In contrast, the gross profit margin experienced a decline from an unspecified level in 2024 to 52% in 2025. While this may seem counterintuitive given the overall improvement in financial performance, it highlights the complexities of the company's business model and the need for further analysis to understand the underlying causes. The company's financial performance has shown a significant improvement in recent years. One key indicator of this growth is its ability to generate positive operating cash flow. According to the latest figures, the company achieved an operating cash flow of RMB 12,987 in 2025. This is a notable milestone, as it demonstrates that the company's operations are generating sufficient funds to cover its expenses and invest in future growth initiatives. The generation of positive operating cash flow indicates a strong financial foundation for the company, positioning it well for continued success and expansion. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, total indebtedness has decreased by 12% from RMB 29,927 million to RMB 26,294 million. This reduction is also reflected in net debt, which has decreased by 11% from RMB 22,193 million to RMB 19,843 million. The decrease in debt level is further broken down into specific categories. Senior notes have decreased from $3,569 million in 2024 to $2,809 million in 2025, while bank and other borrowings have also seen a reduction from $4,655 million in 2024 to $4,040 million in 2025. In terms of interest expenses, the company has experienced a significant decrease. Total interest costs have decreased by 25% to RM 1,546 million in 2025. Additionally, interest expenses charged to profit or loss have also seen a reduction from RMB 1,844 million in 2024 to RMB 1,369 million in 2025. Overall, the company's debt level and interest expenses have decreased significantly over the past year, indicating a positive trend in terms of financial management. The performance of various regions and segments in the company's operations has been mixed. On a positive note, Shanghai stood out with a 3% growth in rental and related income, while its mature office portfolio maintained a stable occupancy rate of 93%. The property investment segment also showed strong results, generating RMB 730 million and RMB 1,565 million respectively. In contrast, other cities experienced a decline in rental and related income, with a -1% drop. The property development segment struggled, posting poor results of -248 million and RMB 2,613 million respectively. Additionally, the others segment underperformed, with segment results of RMB -609 million and RMB -45 million respectively. These regions and segments will require attention to improve their performance and contribute to the company's overall growth. Management's outlook for the company is one of continued growth and expansion. They aim to increase recurrent rental income, which suggests a focus on generating stable and predictable revenue streams. To achieve this, they plan to adopt an asset-light strategy, which involves minimizing capital expenditures and maximizing returns through efficient use of resources. This approach will enable the company to drive business expansion while maintaining financial stability. In fact, liquidity and financial stability are identified as top priorities, indicating a cautious yet strategic approach to growth. Ultimately, management's long-term goal is to establish the company as a leader in its selective markets, positioning it as the best-in-class operator. This ambitious target underscores their commitment to excellence and continuous improvement. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its portfolio with two notable projects. The first is Yangtze, a high-end residential project located within the Shanghai Xinxiandi community. This acquisition demonstrates the company's commitment to luxury real estate development in prime locations. Additionally, the company has acquired Shanghai Sanlin, an urban village renewal project situated in Pudong New area of Shanghai. This move highlights the company's focus on revitalizing underutilized areas and creating vibrant communities. On the other hand, the company has also engaged in divestitures to optimize its operations and reduce liabilities. One notable example is the restructuring of KIC Shanghai, which involved a strategic review and reorganization of the business unit. This move aimed to improve efficiency and competitiveness within the company. Furthermore, the company purchased and canceled USD 400 million 5.5% notes due 2026 for USD 195 million on January 29, 2026. This transaction demonstrates the company's ability to manage its debt and reduce financial obligations. The company's financial performance is highlighted by its commitment to shareholder value through dividend payments. As noted in the annual report, the company paid out a significant amount to its shareholders in the form of dividends. Specifically, it distributed a final dividend of HKD 0.036 per share in 2024. This demonstrates the company's dedication to rewarding its investors and providing them with a return on their investment. That concludes the financial summary for SHUI on Land Limited. Feel free to comment below, and I will be happy to answer them when possible.